And thanks for joining this webinar, as Kirsty said, on tracking the pot to net zero with a spotlight on pension funds. I'm delighted that we will hear from a set of expert speakers from across the pensions industry, regulation, and international organizations as part of this discussion, following a summary of the key insights from my colleague, Valerio. CPI has created the NZFT, the Net Zero Finance Tracker, interactive data platform in order to provide the most comprehensive view available of how major private financial institutions are progressing towards net zero. It is clear that public finance cannot meet the trillions of dollars required each year globally to avoid the worst impacts of climate change. And more private finance, in particular, is urgently needed and is needed at a significant scale. The Net Zero Finance Tracker platform now tracks almost 1,000 of the most systemic private financial institutions. It tracks across the climate targets and commitments they have made, the actions they are taking, and the impact that they are having on the real economy in moving towards net zero between 2019 and 2023. The purpose of doing so is to provide a fact-based view on progress and help wherever possible to foster increased ambition. Whilst the Net Zero Finance Tracker covers all financial entity types, this webinar takes a deep dive into pension funds. Pension funds are key actors within the financial ecosystem with significant financial influence and investment capabilities. Taken together, these things position them to be uniquely placed to play a leadership role on the net zero transition. Based on a sample of 342 European pension funds included in the 2024 platform update, now live on our website, we have released a report analyzing their progress. This provides a valuable use case of how the interactive platform can help to identify where key players are on their net zero journeys and to help to chart the path forward. I'll now hand over to my colleague, Valerio Micale, an assistant director at CPI, based here in the London office, who has over a number of years led our work on tracking private financial institutions and holding them to account. Valerio, over to you.
Thank you very much, Darshan, and hello, everyone. Let me start first with some background on the work that led to the pension funds report. Some of it has been already anticipated by Darshan, but basically a couple of years ago, we started our work on the Net Zero Finance Tracker to comprehensively assess how individual financial institutions are progressing on their Paris Agreement and net zero goals. The Net Zero Finance Tracker aggregates and harmonizes existing data to assess financial institution action. And the goal of this work is to support accelerated transition by providing robust and transparent data on the financial sector to feed into better informed policymaking and advocacy decisions. We track 3 dimensions from intention set at the strategic level under targets, through integration in a day-to-day operations under implementation, up to the final downstream allocation into investment flows under impacts. As we can see in this slide, each dimension is assessed by a set of underlying indicators. Indicators under targets and implementation are assessed qualitatively by benchmarking actions observed against various levels of response or budgets from no action to full response as indicated in the table. Indicators under impacts are instead measured quantitatively, meaning that we report investment levels in dollars or emissions in tons of CO2. We source our information from the latest versions of hundreds of datasets from over 50 data providers like CDP or PRI and many others. Today's report is an example of how the Net Zero Finance Tracker can be used. The sample of European pension funds covered in our study is a subset of our larger sample of financial institutions covered in the Net Zero Finance Tracker. The pension fund subset is derived from a list of top European pension funds and includes more than 300 pension funds representing 7.8 trillion in asset managed and owned. Delving into the trends, what do we observe when we look into the response of pension funds? With regards to targets in general, we've seen significant progress between 2019 and 2023. 70% of pensions in terms of assets have a target. Good progress in adoption of targets has occurred in particular until 2022, with progress in 2023 mostly consisting in a larger share of institutions adopting multiple goals, as highlighted in darker green in the slide. Mitigation targets are the most common goal, as seen by the bars on the right. Most of these goals are long-term or unspecified. Only a small share of pensions in dark green provide higher quality mitigation goals that disclose asset coverage and methods and scenario used. For fossil fuel related goals, the bar on the bottom right must take the form of partial or undefined fossil fuel exclusion policies. Ideally, we will see efforts scaled up on specific fossil fuel phase-out measures as they directly impact carbon emissions, especially compared to divestment. Climate investment targets are also increasing, and in 2023 reached 75 billion, doubling from the preceding year. Only a few entities, however, reporting absolute commitments, with most organizations using proportion-based metrics. Important to take note of those entities that are not acting in this indicator, as surveys found that only 30% of these entities plan to adopt targets in the coming years. So how are pensions doing on implementing these goals? When looking at the implementation, more than half of organizations in asset terms are implementing multiple actions, as shown by the dark green bar on the left, substantially rising in 2022. Most progress on implementation has been driven by climate risk management strategy and disclosures, which reflects the uptake of TCFD climate risk guidelines earlier in the time frame considered. This is followed by internal accountability frameworks and disclosure of emissions and investment data. Action is lacking on engagement, circled in red on the right, particularly with policymakers, despite engagement being considered one of the most impactful decarbonization approaches by pension funds themselves. Limited response may be due to pension funds collaborating with asset managers or coalitions on shareholder and policy engagement, or delegating this completely with only a small share engaging directly with corporates. This calls, as a result, for pension funds making sure that delegated actions actually delivers on the ground. Moving to impacts and investment, which is what eventually matters. In terms of climate investment, when we focus on the energy sector, our starting point is the capital used for the deployment of new assets on the ground as a key indicator that can help measure action contributing to actual change in emission patterns. Here we find that direct project level investment by pension funds is rare compared to other forms of investment, with only 230 million investment tracked in the last years, mostly into solar and wind. We also looked at project level investment, which was enabled indirectly by pension funds through their debt and equity capital allocation into funds, utilities, developers, companies, and other institutions that invest in such assets. We did that by looking along the chain of debt and equity ownership, and the result is that pension funds have been indirectly involved into projects in the power sector for a total value of 331 billion in 2023. So we can see that the potential there is much higher than direct investment. When we break this down, this last indirect figure down, as the graph here shows, we find that in 2023, 57% of energy sector debt and equity capital allocated built new energy projects, primarily wind. We can also see that 43% still went to fossil fuel. And on the bottom of the slide, we can show how this compares to investment benchmarks. Currently, clean energy allocation is below the 69% clean investment ratio observed globally, and below the 80 to 90%, which is expected in a net zero scenario. So more can be done to adjust such trends and reduce new fossil fuel investment. And for that, engagement with investee companies will be key. To understand what levers pension funds can use to achieve a broader impact in the real economy, it's also helpful to take a step back and have an overview of the broader financial system trends. When we give a look into energy assets deployed in 2023 by institutions that are covered by the Net Zero Finance Tracker, we can see that while 95% of the overall direct financing observed for clean and fossil fuel projects came from banks, mainly in the form of commercial debt, asset managers, which are highlighted in violet in the graph, indirectly enabled the majority of financing towards new projects, with more financing going into new fossil fuel projects than in clean energy projects. So engaging with them more broadly is key. And as clients, pension funds are in a privileged position to do that. So what has been driving action so far? So first of all, targets matter. We see that institutions with strong targets are more likely to follow on their goals. Second, large pension funds have generally adopted more developed targets and implementation responses, and this is likely due to better resources and regulatory developments targeting primarily large institutions. Third, institutions that are part of a net zero coalition were significantly more likely to adopt climate targets and implementation actions in 2023. Finally, regulatory development in Europe has been a key driver of transparency and progress for the finance sector in the recent years. We already mentioned the TCFD reporting in encouraging early action on implementing climate risk management and strategies. France has pioneered the efforts, but Nordic countries and the Netherlands have led the way in both target and setting and implementation, as shown in the graphs below. So how can we further improve then the impacts in the real economy? So first of all, bridging the gap between asset ownership and asset manager is the key. We mentioned how asset managers have a massive impact in the indirect deployment of capital. There is a need to make sure that asset owners have a stronger say in the way their assets are managed, for example, by providing voting guidelines, pulling together to increase pressure, allowing clients to have a say on voting, and where possible, directly engaging with corporates. Second, given the real economy impact of asset manager, their clients should influence asset manager beyond own assets. One way to do that is by extending asset managers' assessment to include overall sustainability practices and the management of other assets. And coalition can also support these efforts. Third, investment in passive funds is increasing. Investors should raise demand of net zero financial products and work with asset managers to improve the environmental performance of existing funds. Data providers could support these efforts by evaluating the climate performance of different investment vehicles. Fourth, it is also important to support access to financial structures for clean energy investment to increase direct financing, particularly in emerging countries where a lot of investment opportunities exist. DFIs can facilitate access to suitable investment opportunities in risk-diversified portfolios through blended finance. And finally, the enhancement in portfolio emission data, climate finance taxonomies, and third-party validation are also needed. Regulators should mandate the disclosure of emissions and the adoption of and disclosure of transition plans for corporations to increase data availability for investors, and data providers can support this by consolidating information on corporate emissions and transition plans. I invite you to read the report, of course, for more details on the challenges and how various actors can support them. The panel will also cover some aspect of this, and we also have a suggestion for new work going forward, and our team is going to share a survey, and you can provide your feedback on your options in regard. So thank you so much for listening.
Excellent, Valerio. Thanks. That's very helpful to set the context. As mentioned, please do put any questions you've got in the Q&A box. The team will kind of sort through them and see whether we can loop back to them as we talk with the panel. Moving swiftly on, I'd like to invite the next two representatives who work within pension funds themselves to give their brief views on what it's like sitting within a pension fund and how they're experiencing this transition towards net zero. We will hear from two pension funds. First, from Alexandra Westley, pension scheme manager and investment specialist at Legal & General, WorkSave Mastertrust and IGC in the UK. And then Micale, senior ESG specialist with the Academica pension in Denmark. In that order. Alexandra, can I hand across to you first?
Yeah, thank you very much. I think just a quick overview for anyone who isn't kind of familiar with the Mastertrust. So we're an umbrella scheme with multiple employers. We've got around £28 billion in assets and just under 2 million members. And the Mastertrust is overseen by an independent board of trustees. We've had a very full-on year in the kind of sustainability and net zero space. And I think that's because the dust is settling after a few years of regulatory change, particularly around the kind of climate reporting aspect for pension schemes. It's been a year to have that opportunity to think about what works and what doesn't work and really learn from what we'd like to do going forwards. And our focus really here has been the trustees and the Mastertrust face the same challenge as many asset owners in the UK, which is you can be that one step removed from the actual asset ownership. So our kind of a core part of our net zero strategy is always going to be engagement, and that engagement has to be done with the investment manager and through the investment manager. So in our case, that's working really closely with Legal & General as our kind of primary investment manager. And we've done two quite big things this year to really hone in on what we want to talk about, when to talk with our manager, and what we're aiming for out of those conversations that have been quite transformative in the quality of the conversations that we're able to have. The first one has been a big project to move away from looking at climate change in isolation. So this year, rather than a purely TCFD report, we're broadening out into a sustainability report. And the trustees have taken the decision to look at climate, nature, and people all together, and the kind of interdependencies between those factors. I think we're quite lucky and we get to use LGIM Destination at Risk as a kind of climate toolkit. For the first year, this year, they've been including land use in the analysis. And I think the analysis was showing that about 20% of climate action towards the Paris Agreement will come from the way that we use land. So just things like that are really driving home for the trustees just how interconnected climate and nature are. And then from a kind of people and society perspective, all these things are going to play out in society. No transition will impact society. Transitions will impact society. And also the factors playing out across society will impact our ability to enact a transition in the first place. And so our idea here is really, it's about pulling them together to try and give the trustees a full picture so that they can ask focused questions and then make informed decisions when they're looking to kind of implement their strategy to look for good member outcomes. And then the other thing that we've done is really try and formalize those engagements with between the trustees and Legal & General. And for us, that's meeting twice a year with the stewardship team. Firstly, like really early in the year, January, February time, to have a look at the priorities for the year and also what success looks like out of those priorities, like what we're actually trying to achieve here. And then towards the end of the year, after the kind of core voting and engagement season, supported by all the data on how votes have been taken for Mastertrust assets, and to have a look at what happened and what achievements were made and what we might learn for next year to take another step forward the year after that. So I suppose our challenge is the same as everybody else in terms of that how do you interact with your asset owners, the kind of reliability of data, and it's just about having a look at what we can do within our governance to make sure that it's the trustees setting the agenda and really trying to drive something here.
Fantastic. Thanks, Alexandra. That was very helpful. Really interesting to hear focus on the relationships with the asset owners. and how that's influencing how you're making that relationship more formal. Micale, can I hand across to you now, please?
Yes, definitely. Thank you so much for this invitation, and hello, everyone. My name is Mikkel Bahl. I'm from Denmark in Copenhagen. I represent the Akademikerpension, which is a Danish labor market pension fund with 170,000 members. We're membership owned, so all the revenue go to the members. And also thank you very much to Climate Policy Initiative for this net zero tracker. So much information, great recommendations. So thank you very much for this work. For us at Akademikerpension, we're very happy about this kind of work because transparency in this field is so important, because there's so much going on, and we need it's very important for us to be able to compare and to be inspired and to see what others are doing, and to have this objective evaluations from outside. And I think there's also we should understand quite understandable mistrust from the general public, because there's been a lot of greenwashing for many years. So claiming to be green, claiming to moving towards a better world, to saving the planet, people out there are quite fed up with empty promises. They are seeing that we are heading in the wrong direction, or at least in the right direction, too slow, which is the same as the wrong direction. And so transparency like this is very important in this field. Net zero is central for us, as for many other pension funds and investors. We work with it not just in specific funds, but in general for all investments, the entire organization. We have great support for this work from our members. We have some very active members that engage us throughout the year and make sure that that this is high on the agenda at our AGM every year. I think for us, of course, everything started with the Paris Agreement. The financial flows should shift, and but also I think it's important to recognize the work of the International Energy Agency, IEA, and I think for us, the flagship report, the net zero emissions, where they state that after 2001 we don't need any new fossil fuel projects, is quite important for us. We've done an extensive sell off of fossil fuel actives or investments, and for us, being net zero is also stopping financing of new fossil fuel projects, as is recommended by the high-level expert group from the UN that the Climate Policy Initiative also refer to here. And I think that for us, I also appreciate the mention of banks, which still finance a lot of the direct finance for fossil fuel, which is the main issue on climate right now. So after we divested from fossil fuel companies directly, our focus has now shifted to banks, which we are still invested in, which we won't include, because even though they finance they finance the expansion, that finance fossil fuel companies, not Paris aligned. We believe that it's better to stay invested, and it's usually a small part of their business. But banks is kind of they're the ones. So that's our focus now. I'll try to be brief here. There's so many things to say, but I think if I should just maybe sum it up a little bit, I think for an investor or a pension fund like us that have very ambitious members that want us to be on the forefront, we struggle sometimes a little bit with the lack of support from regulators, where we see now that we are not moving towards 1.5. But what does that mean for an investor? Should we still pursue 1.5? Sometimes we need support there, going into a little bit of the challenges we face with our net zero strategy. But I think that's more or less it from me here.
Excellent. Thanks very much, Micale. That's very helpful to hear. I think that's a powerful set of insights from those working within the pension fund space themselves. Oh, realized my video has not come on. If you have questions for either Alexandra or Micale, please put them in the Q&A. Now let me introduce and move quickly to our three expert panelists. First, David Fairs, who is a partner at the consultancy LCP and is also a former executive director for regulatory policy analysis and advice at the pension regulator here in the UK. So very helpful given Micale's last comments towards the end of his intervention on getting the right support from the regulatory players. Then on to Fiona Elizabeth Stewart, who is with the World Bank's financial sector team, or sorry, the Finance Competitiveness and Innovation team, where she is the lead financial sector specialist. And I know Fiona now for a number of years, and she has deep expertise in the pension space. And also Mahesh Roy, who is the Investor Strategies Program Director with the Institutional Investors Group on Climate Change. Welcome to the three of you. I am going to plow straight into questions for each of you. Fiona, I want to step away. We've talked a bit about the pension fund experience. We've heard some of the insights from the report. We at CPI are incredibly concerned about the interrelationship between public and private finance. Can you tell me a little bit about what could public finance do to precipitate a greater contribution from these vast pools of wealth represented by pension funds? What is it that should be happening within the international financial architecture as such, particularly the public elements, to accelerate things? Fiona, over to you.
Thanks, Darshan. As you know, always delighted to have the excuse to talk about pensions. So I think so the World Bank and the MDB's world that I come from, I think it represents actually a good sort of catalyst to put those two worlds together, and that's what we try and do. And I would say there's sort of three ways that we can help public and private finance come together and help pension funds globally, institutional investors globally, make the sort of investments that their experience that we've just heard about, how you go either directly or indirectly into these projects, particularly in the emerging markets, which is where we're really going to have the impact that we need on adaptation, and where the finance really isn't flowing yet to the emerging markets. We know that's only about 16% of climate finance goes to emerging markets ex China at the moment. How do we actually get that pathway flowing to where it's really needed to meet the SDGs and the Paris Accord? Well, there's kind of three ways that we help and can do that. One is through our own bonds. So obviously we at the World Bank and many of the other MDBs issue bonds, and we like to say obviously all of our bonds are sustainable bonds because that's our DNA. That's where all our funding and projects and the money we raise in the capital markets goes to. So actually going through the bonds, the indirect investments, if you like, is a very useful channel for the big institutional investors. So as well as the sort of plain vanilla bonds, we're actually doing some quite interesting ones in the last few years that have very specific outcomes. It was interesting, I think, Valerio, one of your pillars is kind of measuring impact, which I really like, not just the policy, but what's the impact. And we're actually finding that investors are increasingly asking that, what is the impact? And so things like, I know many of you will have heard of a famous rhino bond, everyone loves their rhinos, which actually has a payout dependent on the increase in rhino population in some parks in South Africa. People really like those sort of instruments where we're seeing outcomes. And I think there's a bit of a trend of that. We have some sort of water-related ones in Vietnam, some forestry-related ones. I think that's a bit of a trend in the market, but it really I hope it helps institutional investors make the sort of investments with impact that they're looking for. The second is guarantees, and we're working hard to really think about how can we really use a balance sheet as effectively as possible? How do we really get the leverage from the really precious concessional finance that is out there? And one way is through sort of guarantees is a way that we can do that. So, for example, there's, the biggest solar park in Africa is a big project in Egypt. And that had a project bond, which MIGA, a multilateral guarantee organization, provided a guarantee for that. And that helped then crowd in, again, the pension funds locally and globally to invest in the bonds of the SPV of that project. So it might not just be specifically sort of direct lending, but these guarantee type ways of leveraging. And we're really trying to think hard about how we do that as effectively and efficiently as possible. And then the last one I would say is actually really, I think, a very interesting trend is co-investment. So our IFC colleagues have, for example, there's something called the MCPP, which is the Managed Co-Lending Portfolio Program, where some of the big it's been more the insurance companies, but invest alongside the IFC in a kind of syndicated loan program, which I think is a very interesting model. We're seeing some of the Dutch pension funds, maybe some of your colleagues on the call, actually, some of that know that the Dutch pension funds have come together and they're investing, kind of trying to invest alongside the MDBs. And we're actually seeing initiatives where the pension funds in emerging markets are coming together to form co-investing groups. We helped set up one in Kenya, the KEPFIC, the public pension funds in Kenya came together to invest in looking for infrastructure, renewable, etc. projects. So I would say through our bonds, through our guarantees, and I think these co-lending platforms are three trends that can really help direct the capital to where we need it going forward.
Fantastic, Fiona. That's very, very helpful, and it's great to hear of the work around innovative products, both the route to expanding exposure through the vanilla bonds. It'd be interesting actually to go back to Alexandra and Micale and find out whether you are considering, exposures to the MDBs, because in that space they're probably some of the safest options that you could consider. And it's very helpful there, Fiona, to hear about the variety of options you have in play. I'd like to move quickly to David. David, we've heard reference about the regulatory content and how that could support what pension funds are trying to do, or it can act as a barrier. Can I ask you, how can the regulatory space continue to evolve and develop in order to support pensions specific climate action, particularly here in the UK, but global thoughts are also helpful. David, over to you.
Yeah, thank you. So I was at the pensions regulator and was the executive responsible for climate change. So I led the implementation of TCFD disclosures, firstly for schemes over $1 billion, and then subsequently for schemes over $1 billion. I think there is consideration needs to be given to the extent which you then maybe put slightly lighter requirements, but requirements on schemes below $1 billion. And when we introduced those requirements on pension schemes, we actually put it on pension schemes first. So we put it on pension schemes, then investment managers and banks, and then on corporate entities themselves. And we recognized that that would mean that actually the data flows that the pension schemes are relying on may not be perfect. Methodologies would evolve. And, to what Micale was saying, I think the job of regulators now, because we've had TCFD disclosures for a year or two, is to ensure the consistency and the integrity of that reporting. And it's not just telling a good story. There's actually substance and there's accuracy, as I say, integrity behind that. Secondly, in the UK, the pensions regulator is now encouraging, not mandating, but it's encouraging schemes to set net zero targets and to set out how they are going to achieve those targets. So put in place clear transition plans. And I think actually the tracker is an incredibly useful tool. It's useful, I think, for the market to see actually the progress in terms of development and the maturity of the market. But it's incredibly important where you've got a regulator who's encouraging but not mandating to see the rate of take up and how that is expanding. So I think that's important. And the previous government in the UK, not necessarily this government, previous government was very much talking about implementing sustainable disclosure requirements and setting benchmarks of carbon output so that industries could benchmark themselves against those and see how well they were doing for their particular industry. I think one of the challenges with TCFD reporting is that it can be quite static and it doesn't necessarily need you to actionable plans. I think setting net zero targets and having transition plans takes you in that direction. But I think sustainable disclosure requirements gives you clear, actionable information that you can build your portfolio on. So I think it's an interesting space. It's evolving and developing at the moment.
Thanks, David. And just to pause on encouraging, not yet mandating. Given your vast experience, how quickly do you think we need to move to mandation? And what would be the benefits of doing so? And what are the hurdles which are preventing us doing so?
Yeah, I think, you know, I think Valerio was talking about some of the resources that schemes have, and we have certainly in the UK, and I suspect across Europe, schemes of very different sizes, who very different levels of governance capabilities and resources in this area. So I think, you know, when you mandate something, and you know, it's part of the logic of mandating TCFD for schemes over 5 billion and then 1 billion. When you mandate something, you have to be certain that the market is capable of resourcing and supporting those requirements. And as a regulator, it was certainly my concern that actually there wasn't the expertise in the market at the scale needed, that if you put TCFD reporting on day one across schemes over 1 billion, that actually that was achievable. So I think when you go to something like net zero and setting transition plans, you have to, and you want to mandate it, you have to understand that the market can support that. But what you're doing is in terms of setting clear milestones around those transition plans, is enabling people to check the robustness of the plans and whether they're actually achievable. And so I think, you know, you've got to wait for the maturity of the market to catch up to where you are in terms of whether you go for encouragement to mandation. So I think, you know, it's a complicated picture. It's quite changing quite rapidly, but I think that's the way you have to look at it.
So some optimism in the sense that we are making progress rapidly. Mahesh, can I turn to you? You represent a coalition of investors which is committed to making progress in this space. It'd be really helpful to hear from your side, just thoughts based on the conversation that we've had so far. What role can pension funds particularly play in channeling flows through other parts of the financial system? Valerio talked a bit about the importance of asset owners, asset managers, and the influence pension funds have on them. Mahesh, could you share your thoughts from an IIGCC perspective?
I think pension funds are, I guess, a very important part of the financial value chain. They predominantly operate in secondary markets or purchases of financial products, but it helps recycle capital into the primary financiers like banks, private equity firms, etc., and project developers. So if pension funds require information to make decisions and to fulfill their fiduciary duty to make risk-adjusted returns to their beneficiaries, then whatever those requirements are, will filter their way down through the financial value chain. So with pension fund, you know, as they do in working with IIGCC, sort of come together to set expectations of their managers or of the companies that they invest in through managers, etc. Those expectations will go down through the value chain. And I think you've seen, you know, that play out over the past few decades, where institutional investors have been key in requesting corporates disclose their carbon emissions. And now that has moved into a world where that is becoming increasingly regulated and standardized, because you know, both the issuers of that debt or those equity securities, the arrangers of that in banks, etc., and other financiers understand that in order to move this capital up to those big pools of capital and pension funds, and indeed other endowments and insurers and other asset owners, that this information is required. So I think you know, pension funds, particularly you know, when they work together, as David mentioned, they are very resource constrained. They're generally not profit-making entities. They only have so much resource they can put towards these sorts of things. But when they come together with groups like ours in IIGCC and start to think about ways as an industry, what's important to them and how they can engage with their stakeholders, then you can really start to change behaviours and show, I guess, what is possible. And then once that becomes somewhat of a norm, then hopefully, as David outlined, regulators can feel confident to act and put regulation in place to standardise those sorts of things.
Thanks, Mahesh. It's interesting to hear you say that acting in cohort, and also to reference sometimes they don't have lots of depth when it comes to capabilities. I think, there's maybe a bit of a misperception that as relatively large actors in the financial ecosystem, they have ample capability and ample personnel, and maybe running much bigger teams than in reality they are. So I imagine having the encouragement that comes within a coalition space and being able to understand what best practice looks like, what we heard Alexandra talking about, some of the stewardship regularity that they're starting to introduce in, I think it was this year. Is that the sort of thing you see being exchanged by members of IIGCC?
Yeah, absolutely. And I guess that's sort of, we were founded by Pension Fund in 2001, and a number of them now sit on our board. And so our mandate for sort of the past 20 odd years has been to help institutional investors, starting with pension funds, but that's broadened out to other asset owners, includes asset managers now, to sort of come together and work together on best practice to sort of understand what they as organisations can do, and also what they as an industry can do, obviously within the constraints of competition law and all of those other good things. But certainly, we've worked together with them on founding initiatives like Climate Action 100 Plus, the Paris-aligned asset owners, which is predominantly pension funds, and use those as platforms for best practice, and then sort of codify a lot of those, particularly in the team I lead, into guidance like the Net Zero Investment Framework, which is the most widely used framework by pension funds that have committed to net zero. And so in doing that, everyone will interpret that differently and act in their own ways, depending on the mandate given to them by the beneficiaries and their interpretation of the law and the jurisdictions they're in. But there is a consistency there. So it sends a clear signal to managers, but also other actors like data providers, because data and information and consistent data and information is really important. Investment consultants who help many of them make these decisions as well, and also to many others' points, policymakers, and sending clear signals to policymakers who really hold the key in the net zero transition on what's required to help them, to help investors, help transition the assets that they invest in, and also to work on any sort of roadblocks and barriers that might be coming through, whether it's direct regulation of pension funds themselves or real economy policy and regulation that might be slowing that progress.
Thank you, Mahesh. Let me go back, Fiona, to you. I'd like to ask you, given what you've just heard from David and Mahesh about what is happening within pension funds, within groups, from your perspective at the World Bank Group, what advice, guidance, suggestions do you have when it comes to pension regulatory reform that would actually drive some of the real economy impacts in some of those critical economies that you referenced when you were talking at first, particularly when it comes to things like the deployment of new low carbon infrastructure or the phase out of fossil fuel plants? Fiona, can I hand back to you?
Sure. So we're many steps behind in most of the countries that we work in. And there are actually some very big pots of pension assets. They may not be on the sort of global scale, but in terms of percentage of GDP, some of the Southern African countries, Asia, where I am at the moment, Indonesia and Malaysia, they have pretty big pension funds. But, we're at the stage, a lot of them are at the stage where, they've heard the ESG thing. We heard TCFD, transition, net zero. We're not there. They're not there at all. So there's an awful lot of, I think, I would love to take this panel to, some of my countries with me. And can we do this again, please? And explain this to some of the big institutional investors in emerging markets, because that long-term local currency capital is incredibly precious and incredibly vital. So, and I think taking some of these messages, sort of the Europeans are leading. If you did your survey for, and I'd love to do it with you actually, Darshan and colleagues, if we did this survey for the big institutional investors in the emerging markets, you know, we're going to have an awful lot of, you know, fewer ticks in the boxes. But I think we need to keep passing this on to get the local currency flowing in the same way as the international. So that's the first thing I would say. The other thing, I actually have a question kind of back to the panel and to you, is that, are there any risks to the emerging markets of unintended consequences of this? So I'm thinking about, you know, we've seen things like, if you set the bar so high and you're expecting, you know, the investments that you make to have all these plans and you know, have nice transitions, they're just not there yet in the emerging markets. Is there a risk that you end up unintentionally driving funds away from the countries that need it most back to the ones that are actually kind of reporting? And actually, is there a danger it could go in the wrong direction? Is there unintended consequences of this? And I'm always like a broken record with have we thought about the emerging markets? What about the emerging markets? I don't know, Mahesh, if you've looked at this, or if any of the panel have thought about, could there be any unintended consequences we have to watch for in terms of making sure these policies are appropriate and you're taking into account the context in the emerging markets when you're making your investments?
Thanks, Fiona. That's a good question back to us. And I know from my FCDO/DFID days, it's certainly the unintended consequences on emerging markets were of key concern. And, you know, it's very interesting when you are involved in coalitions like IIGCC and GFANZ, and you see how they're building up presence in Africa, in Asia, in Latin America. It'd be really interesting to overlay some of the analysis that we've done in Europe into some of those different regions and do some comparative work around that. Mahesh, can you consider that? Because I'd like to come back to you. But David, I'm actually going to come back quickly to you because I'd like to kind of put that question that Fiona had across to you as well. Can you tell us a little bit about what you see as the key differences across the regions? Well, the research that we've done is very European focused. If we were to expand it into the US or other regions, what would you anticipate seeing?
Yeah, I mean, I guess the US is quite challenging, particularly coming up to an election in terms of consideration of climate and sustainability type issues and the reporting of those. But I think Fiona has got a point that you know, when you're requiring disclosure of certain metrics, you can improve those metrics overnight by just investing in sectors which are already quite efficient, quite clean, and you avoid those that are actually going to give you kind of bad metrics and make your overall portfolio look bad. Whereas the reality of what we really need to do is to invest in some of those things which do actually produce bad metrics, and through investment encourage the management of those organizations to look at how they can change their manufacturing process or production process to actually make it a much more greener and sustainable production process. So it's the engagement and taking some of the worst polluters, some of those more challenging organizations, entities, from a climate and sustainability perspective, and transforming them. And you know, inevitably that means that if you look at your metrics in a cold light of day, it doesn't look great when you first kind of do those sort of things. So I do think you need to get behind just the pure numbers and not just say because one scheme has a better metric than the other one, that one must be clearly a better climate and sustainability focused fund. That may not be the case. It may be that they're actually investing in industries, they're engaging with management, they're trying to change the sustainability of those industries, and that is what we need in terms of creating a more sustainable planet. So I think Fiona's absolutely got the right point. You can't just focus on metrics, you've got to go behind it and understand what the investment, the mandates they've got, and how they're implementing those.
Thanks, David. It's interesting that you bring up the metric point because, you know, one of the advantages of doing the role that CPI has done is I've watched as Valerio and the team have very carefully hand selected a set of metrics underneath the tracker, which aim to do, you know, just that, both reveal the good progress that is underway, as well as bring some transparency and some clarity around some of the things which are more challenging. But I think you raise in your comments some of the very real challenges around transition finance and making sure that we are still providing investment to those corporates and financial institutions which are genuinely keen on making and contributing to the shift that needs to take place, and thereby kind of tackling some of that challenge around what constitutes transition finance, how much of it should be provided, how do you constrain it within a temporal time so that you're actually moving forward. Mahesh, back across to you. One, to just respond to the question that Fiona handed across to you, but I'd also like to pick up on David's point around data and information for pension funds to improve their capital allocation. By some accounts, there's more and more data available on an almost daily basis, both in the primary markets and in the secondary markets. What are you seeing from IIGCC in terms of how this data is being used and how it's being presented? Would love to hear your thoughts on that. Mahesh, over to you.
Great, thanks. I'll address Fiona's question first, and I think I guess the blunt answer is that we have seen unintended consequences probably in the first round of setting net zero targets, and not just in the initiatives and the frameworks that we I guess develop and work with investors on, but across sort of the different asset owner alliances and the different target setting methodologies, and the simple fact is that when looking at financed emissions on a portfolio level, as David outlined, and you're just looking at a straight reduction of emissions in line with those pathways, those global pathways of say 7% reduction in emissions a year, the temptation is to trade out of those emissions, and that has been a massive unintended consequence of setting targets using financed emissions. We received feedback directly from managers and pension funds saying their investment universe was shrinking, that there was decisions to allocate away from certain sectors and indeed emerging markets. So we started getting this feedback a few years ago. And in our latest update of the Net Zero Investment Framework, we actually recommended that investors don't set targets using financed emissions. We also have started an emerging markets and just transition workstream that follows on from a sovereign bonds or a sovereign engagement workstream that looked at, instead of using those global pathways to look at different assets or different regions, actually how can you look at country or localized pathways, particularly ones that can take into consideration sort of fair share principles that are outlined in the Paris Agreement. No easy task, but certainly we have evolved our thinking here. Not that we ever said that financed emission targets were the best metric. We actually think that they are probably a secondary metric. They're a metric that an investor should check to see, using attribution analysis and understanding what's been traded in and out of a portfolio to understand why emissions are going down, and fully recognizing that even investing in climate solutions, so the scale up of solar, particularly at the manufacturing or the development level, solar, wind, etc., that will actually increase emissions in the short term, but it will decrease emissions, economy-wide in the longer term. So how do we account for that? So indeed, I think the early days of thinking around net zero finance and net zero targets did have some unintended consequences, and we're very aware of that. And certainly, numerous managers and pension funds have spoken out about this, and there's over 100 investors in the emerging markets just transition working group that kicked off earlier this year, looking at exactly this issue. And we had great support from investors to downgrade financed emissions and sort of portfolio targets to objectives and make them secondary when we updated the Net Zero Investment Framework. So I think we need to, on an ongoing basis, make sure we can, check what's doing, check the impact that these sorts of targets and metrics are having, and adjust accordingly. Because I think now we all really realise that one of the biggest roles investors can play is actually allocating capital to where emissions need to reduce, particularly in emerging markets and developing economies where they don't currently get that financing at the scale that's required. On the second part, on data and metrics, of course, if you take climate out of the equation, for investors to look at how to produce risk-adjusted returns for pension funds for their beneficiaries, you know, data and metrics are paramount to understanding that. And so the more that can be made available, the better. So I think that in developed markets, in publicly listed equities in particular, because of the long history and engagement and stewardship that's been happening, particularly around carbon emissions, that's fairly well covered, and even estimated data is going okay, particularly for scope 1 and scope 2. But if you think about those broader things and just take the focus off emissions themselves, and you think about the risk of investing in emerging markets, indeed, and we do encourage investors where possible, where within their mandates, to invest in emerging markets. There is obviously a scarcity of data there. There's great steps being done by the multilateral institutions like the World Bank in releasing the GEMS data. There, of course, be more granularity there, as it's been fed back by many. The need for data and the types of data is evolving. Emissions data in developed markets, public markets, is fairly good and fairly well covered. Could always be improved, but again, I think progress there is going well. But on other ways of looking at these things, particularly country level data, when it comes to nature and nature's interrelation with climate as well, there's needs for data. So again, data and information will always be paramount to investors. And if climate change is part of their overall investment thesis and part of what they're wanting to analyze as part of those risk-adjusted returns, then the more data, I guess, the better. I guess the flip side to that is it needs to be the right data, and then the understanding of when to find that data and also when to ask for that data is, as David alluded to before, not just for pension funds, but for issuers or companies or assets, and also managers. If there is so much focus on certain types of data that's non-material, say scope 3 for assets that don't have material scope 3, etc., then you can sort of take up allocated resources into what is actually necessary and what's needed. So again, I think
Right, Mahesh, that's very helpful, and I'm sorry to kind of interrupt there, but I'm conscious of time, and I'm keen to just do one final round across Micale and Alexandra. 30 seconds from each of you on what regulatory support would be most helpful for you. Just 30 seconds each, and then I'm going to come back to the panel for your closing thoughts on one specific intervention that you think would accelerate things. Let me go first to Alexandra.
I think the regulatory support that we'd be looking for is anything in terms of driving that actual real world progress in terms of decarbonisation. We've got a very diversified portfolio, and so you kind of get to the point where you can only really decarbonise as fast as the general economy does. So I think that is the big push here, and everyone has a small role to play.
That's great, Alexandra. So anything that helps really shift the needle on the real world context. Micale, over to you.
Yeah, I agree. It's difficult to pinpoint, but as a diversified investor, a universal investor, we're not invested in specific companies. We're invested in the economy as a whole. So for us, setting a price on emissions is basically what we need, because it's still more profitable to finance companies that are not helping.
Got you, Micale. Setting a price on emissions, always an aspiration that a lot of people hold. And then quickly around the panel, Fiona, can I go to you first? Just 30 seconds. What one intervention would you be after?
Your final pillar, the impact. Can we please really push on measuring impact, not just the targets, not just the intentions, but the impact. That I think will be key to really getting the funds to where we need it into the emerging markets that we work in.
Excellent, Fiona. Good call to action. It's the hardest one of the 3 pillars, but it's where we really kind of crack our knuckles and put our brains to work. David, over to you.
Yeah, I mean, very quickly, I think we should move away from sort of static disclosures to those which actually show movement and create clear, actionable actions that investment managers can take action upon. So action rather than static disclosures, I think.
Dynamic rather than static disclosures. Thanks, David. Mahesh, last thought from your side?
Yeah, I would just say, continued collaboration and reflection on the path we're going on. To my previous point, no need to be path dependent. It's always good for reflection and that investors continue to collaborate and engage with their stakeholders.
Fantastic. So that leaves me to just thank you all, those of you who contributed. Thank you to those who joined the webinar. We really appreciate the attention and time you've taken today with us. Please do take a look at the reports. The team's put many of the links into the chat. There are a number of questions that we didn't get to. If possible, we'll try and furnish swift answers to those. But do feel free to reach out to CPI or any of our panelists if you have follow-up questions. Thanks very much this afternoon.
Thanks, Dash.